Hi, welcome to my channel. In this video, we are going to be handling T accounts. Still continuing with fundamental principles of accounting. So we are going to look at T accounts. Another name for T accounts is ledger accounts. Ledger accounts, or they can also be called individual accounts. The reason as to why they are called T accounts, it's because they are in a T formatting. They are drawn in a T formatting. So what are T accounts? No one is going to ask you that. So T accounts are a visual presentation of the transactions that are recorded in the general ledger. We shall be looking at the general ledger also, but I think in the next videos. So T accounts, also known as ledger accounts, and then the individual accounts. Examples of T accounts. Examples of T accounts. They are all the accounts that you know: capital account, rent, expenses, account, machine, account, cash, account, bank, account, salaries account, electricity account. They are very many, but these are some of the examples of T accounts. Inventory, like they are very many. All the transactions that you can think of. Those are examples of T accounts. So let's have an example. So this is our example. The business owner deposits 500 UDX 500 into the business. So a deposit is something that is put in the bank. So first we have the bank account, then into the business, like invested the 500 into the business. That is capital. So we are having bank and then capital. Those are the two accounts that we are going to have. In case we are to prepare T account, you are going to have the bank account and then the capital account. So bank account, and then the capital account. So the amount we have here is 500, and in accounting, every business transaction has a debit and then a credit. So here they deposited 500. So the money in the bank is increasing. Bank is a current asset, and assets increase by debiting. So here, let me say, like in case they give us a date, maybe 1st Jan 2020, the business owner deposits 500 into the bank. So here we come on the debit side. We say 1st Jan. So they deposited 500. But here we cannot write bank under bank. Like when you're recording these transactions, what you put under the description, you put the opposite account. So you will write capital here instead of bank. So you write capital of 500. Like that. Then the capital account, like they deposited 500 into the business, capital is increasing, and capital increases by crediting. So we come here on the credit side and we write 1st Jan. Then under the description you write the opposite account. So here we are going to write bank. So you write bank 500. Yeah, and that is done. So we are done recording the transaction in the T accounts. So the last thing you're supposed to do is to balance. So how do you balance? So here you look at the bigger side. You get the bigger amount and put it on both sides. So this side has 500, this side has 0. So here we put 500,000, here we put 500,000. Like that. So in case there was something here, any amount here, we would have subtracted this minus this to get the closing balance. But there is nothing here, so this same figure will become our closing balance. And closing balance, we rate it as balance carried down, which will be 500,000. Then we come here. On this side, same thing. Like you see, you put the greater amount on both sides. So this side has 500, this side has nothing. So we are going to put down here 500 on both sides. 500. Then this minus 0, that will become the balance carried down, which is 500,000. So that's how we balance off the T accounts. And those are the T accounts for that transaction. Yes, so let's have another example. So this is the second example. It says on 3rd Jan 2020, there was purchase of inventory of Yugi X 700,000. It was paid in cash. Yeah, so here we're having purchase of inventory. So when they purchase inventory, it means that inventory is increasing, and inventory is a current asset. Assets increase by debiting. So we have inventory is increasing, and then they paid for that inventory using cash. So cash is reducing. So we have two accounts. We have the inventory account, and then we have the cash account. So those are the T accounts that we are going to prepare, or the ledger accounts, or the individual accounts. So inventory account, debit, credit, cash account, debit, credit. So these are the two accounts that we have. We said inventory is an asset. It increases by debiting. Then even cash is also an asset, a current asset. They are all current assets, and they all increase by debiting and reduce by crediting. And in this case, this is increasing and this is reducing. So we shall debit this and credit this. So here we come here and write 3rd Jan. So under the description, we write the name of the other account. So here we shall write cash. So cash, then the amount 700,000. Then we come here on the credit side, since cash is reducing. So we write 3rd Jan. So under the description, we write this inventory. So inventory 700,000. Yeah. Then how to balance it off. We said you get the bigger figure and you first put it on both sides. So this side has 700, this side has nothing. So 700,000, 700,000 minus 0. So the balance carried down will be 700,000. Then we come this side too. 700,000, then 700,000 minus 0, so balance carried down is 700,000, and that is how it is. So those are the examples, some of the examples of T accounts. Then another thing about T accounts, in case you are new to accounting, all you should know is this side is supposed to be for debit and this side is supposed to be for credit. Debit is, which hand is this? Left, then credit on the right. You don't interchange them and put credit this side or debit the other side. Yeah, so that is all about T accounts. In case you have any questions, you can ask. Yeah, in the next video, I think we shall be handling either journal or journal ledger.